Traders now pricing in a 25 basis point cut for September's Fed meeting. Joyce Chang of JPMorgan seeing a more aggressive path, writing this: we now expect the Fed to speed up rate normalization, delivering roughly 100 basis points of easing by year-end, with more front-loaded cuts of 50 basis points in September next month and another 50 in November. Joyce joins us now. Joyce, I could barely get my words out because that is quite a bold call, especially at a time where it doesn't seem like the economy is falling off a cliff. Does that make you rethink it, or are you just doubling down?
No, well, I think for the next 6 months, the path is actually clearer now because it's the combination of inflation being lower, the supply side effects taking hold in the U.S. more, but also the employment numbers. And we're seeing a disconnect from the rest of the world. I mean, in the rest of the world, we're not seeing lower wage inflation as we're seeing in the U.S. And so I do think that the Fed feels like there is more scope now to ease. Now, you could still have this resetting in 2025, but the combination of the disinflation trend that we've been seeing along with the employment path, I think, means that they do feel more comfortable doing something more aggressive. And I think that's what the messaging is going to be going into Jackson Hole.
I can just hear Justin Cole, who was on yesterday, former managing director at Barclays, screaming at the screen saying, what are you talking about? We just heard that Walmart is not seeing any weakness. There basically are economic profits that are starting to accelerate for the other 493 companies in the S&P 500. You're not seeing that type of falling off a cliff. How can the Fed justify cutting by that much at a time when they're not seeing that kind of weakness?
Well, you're not falling off a cliff, but you're going to see more of a synchronized slowdown in global growth. I mean, we have U.S. growth. I mean, not going into a recession. The recession risk, 25 to 35% is where we're at. But I mean, we have growth slowing in the U.S., closer to 1%. So the best of the U.S. growth story is, I think, behind us. It's not a recession. I mean, we don't have the conditions for a recession. We don't see the credit market stress. We don't see the profit margin compression. We see really no energy or financial market shock. I mean, we had the earthquake with the carry unwind, and now it's settling down. But I do think that, there is scope. We had easing that had been programmed in before, but there's scope to go more aggressively right now, just given the combination of data that we're seeing on inflation and also on the employment questions that lie ahead.